balance sheet is one of the three key financial statements of a company. It's a snapshot of the business assets and liabilities on a particular day. Effectively, it says what the business owns and what it owes. Financial statements also include the income statement, measuring the business performance, income and costs over a given period, and the cash flow statement, showing how the business has made and disposed of cash and liquid funds during a period. Today we're focusing on the balance sheet, looking at what it shows and what it holds. First up, why do we care about the balance sheet? As a shareholder of a business, you want to know what the business is actually worth. The value of a business is in what it owns, what it owes, and what it produces. We want to know the assets the business holds and how much it owes, so we know how much equity we have. Because of a practice called double entry bookkeeping, the balance sheet will always balance. We'll go into this in more depth later in the video, but for now, remember the equation assets equals liabilities plus owner's equity. Effectively, owner's equity is equal to the assets minus the liabilities. We can break the balance sheet into three components: the assets, the liabilities, and the shareholder or owner's equity. The assets are effectively what the business owns. These can be split into current assets and non-current assets. Current assets are cash and other assets that are expected to be converted to cash within a year, such as cash balances, trade and debtors or trade receivables, and stock inventories. Non-current assets are the company's long-term investments, for which the full value will not be realized during the accounting year, such as investments in other companies, intellectual property, plant and equipment. Liabilities are the other side of the coin, what the business owes. These are split into current liabilities, which are satisfied within a year, such as account payable or trade creditors, wages payable, interest payable, and taxes payable. As well as all current liabilities, you have non-current or long-term liabilities, such as notes payable and bonds payable, effectively the long-term borrowings. After paying off all liabilities, the business is left with its net assets, which are equal to the owner's equity, or how much the owner actually has. These include common and preferred stock, retained earnings, and additional paid-in capital. Now we know the different sections of the balance sheet. What does it all actually mean? I'm going to run you through two examples today. First up, looking at a person buying a house, and next, I'll run you through an actual company's accounts. In the real world, you may want to own a house. So you make it big and boom, you have £250,000 cash savings in your bank account. You're searching online and wow, you see a beautiful house for £1 million and it's everything you ever wanted. So you think you can get a mortgage off the bank and buy the house, a dream come true. But what would your balance sheet look like before the mortgage, before buying the house, and after everything? First up, before we do anything, you have £250,000. This is cash, the most liquid asset and is a current asset. On the liability side, you haven't applied for your mortgage and you're debt-free, so your liabilities will be zero. But remember your equation, that your assets are equal to your liabilities plus your equity. Therefore, you have equity of £250,000 and everything balances. Equity is how much you own. You own your cash, so there you go. What about after you get your mortgage? Well, now you owe the bank £750,000, but you have £1 million in cash. So your assets will be £1 million, your liabilities £750,000, and your equity will be the difference, £250,000. The interest in the next year will be current liabilities, but since most of the mortgage will be paid off in more than 1 year, these will be non-current liabilities. Once you buy a house for £1 million, lucky you, you'll have no cash, but you will have the house of your dreams, a non-current asset. Now, you have the £1 million non-current asset, and as before, you have £250,000 equity in your home, and you have £750,000 in liabilities. Building on the example of the house, we can look at a business in the same light. A business will have its own assets, liabilities, and shareholder equity. To prove how easy understanding a balance sheet is, we're going to look at Apple, one of the biggest companies in the world. From the MacBook to the iPhone, Apple Music and Air Pods, what does the company now own? As of the 29th of September 2018, Apple had $131,339 million in total current assets, made up of everything we spoke about earlier in the video. Its cash and cash equivalents, accounts receivable, and inventory, among other things. All of these assets are expected to be turned into cash in the next accounting year. Adding in the non-current assets of marketable securities held for more than 1 year, and properties, plant and equipment, we get to the total assets of $365,725 million. Looking to the liabilities and shareholder equity section, our current liabilities of $115,929 million are made up of accounts payable, commercial paper, and term debt, effectively payments due in the next accounting year. We then add on the term debt lasting more than the next year and other non-current liabilities to get a total liabilities figure of $258,578 million. But wait, the total assets and total liabilities don't match. Remember our formula. The difference between these two figures is the shareholders' equity of $147 million, made up of common stock and retained earnings. In all, the balance sheet balances.